Now on to the legal portion of our programming. You know, whenever you get invited to come and speak, you have to be careful when you invite the lawyers because they may not let you out of the room and they may suck all the air out of the room. I'm hoping that we can give you guys a really interesting conversation today. I think just to tell another joke, it's hard not to do this, but we're in London. I see the Thames. As my colleague Susan told me, it's the Thames, I think, is the way to pronounce it. And as Shakespeare once said in Henry VI, the first thing we do, kill all the lawyers. But hopefully you don't do that after our talk today. I'm Sharif Neishiwat. I'm a lawyer for Ripple. I support the development incubator called RippleX at the company. Here with me today is School of Law professor at Rutgers, Yuliya Guseva, and my colleague at Ava Labs, Ming Choon. We're going to talk to you today about regulatory enforcements and its impact on digital asset markets and on innovation. We really wanted to be thoughtful when we put this speaking portion together. We wanted to have a conversation. We knew who we were speaking with, folks who are in the research community, folks who are in the university community, folks who work on the technical side of things. And we didn't want to belabor the legal issues, but I've heard over the last couple of days folks using the word securities in almost every conversation that we've had. And I wanted to do something real quickly before my colleagues introduce themselves. Show of hands, how many of you are lawyers? This is the Socratic method, folks. We're going to be engaging here. Okay, now how many of you are researchers, university professors, or in the university space? Okay. How many of you have heard the word Howie? Okay.
Oh.
And that's sort of part of the problem, right? That folks aren't concentrating on the things that they should concentrate on. So with that being said, I'd like to introduce my colleagues. Yuliya, why don't you start?
I'm a professor of law at Rutgers Law School, which is the State University of New Jersey's law school. And we're in Newark, which is very close to New York, just across the river, but unfortunately not in New York per se. And I'm running the collaboratory and a fintech program for the law school. We are collaborating with various industry partners as well as various universities. And also, unfortunately, I'm the new vice dean of the law school, so I'm also an administrator. And of course, I write in the area of crypto, digital assets, specializing in capital markets and financial regulation.
Ming?
Great. Hi, everyone. I'm Ming. I'm Deputy General Counsel at Ava Labs. I work on all things legal, regulatory, and policy. As you can imagine, a lawyer in this space needs to work on. I started my law career at Latham Watkins as a banking attorney. I moved to Consensus about 4.5 years ago in-house to work on crypto projects. Most recently, before Ava Labs, I was at Meta, working on privacy, which was a lot of fun, as you can imagine. And in the past life, before I was a lawyer, I was an engineer. I was at Citibank and then a hedge fund working on quantitative software.
Great, thank you. Before I came to Ripple, I spent the first decade of my career as a prosecutor, both in state and federal law enforcement in the United States, mainly prosecuting financial crimes. I spent some time on the bench as a U.S. administrative judge, and then I spent the rest of my time basically at either banks or technology companies, having come to Ripple from a Block 1 company. And during my time as a prosecutor, I spent a lot of time with financial regulators. In fact, it's all I basically did. We brought and supported enforcement actions, both state court actions and federal actions. Recently, we've seen an emergence in the digital asset space. Consumers, financial institutions, central banks, they've all come into the space. And what we've also seen is a reaction from, particularly in the US, regulators, ramping up their efforts to try to exercise a level of regulation over the space. In the absence of legislative certainty or guidance or consistent legislative framework, we've seen regulators, particularly in the US, use the enforcement action in order to exercise their jurisdiction over what they perceive to be their jurisdiction over the space. We know from history and my own experience that enforcement action is a great tool to fight fraud. It's a great tool to fight theft, to correct criminal behavior. It's less effective a tool in the regulatory space when it's when it can be viewed as potentially disruptive, both in to markets and to innovation. And we wanted to focus on both those areas in the short time. Professor Guseva has been in the process of writing and pitching a law review article, which for those of you who aren't lawyers is basically a very fancy white paper on the topic. And she writes very extensively on the distinction and what the short-term or the long-term impacts are of enforcement. And so I wanted to start with you, Professor Guseva, if you could talk to us a little bit about enforcement specifically and what it's done in the digital asset space.
Thank you so much, Sharif. That's a great question. And please never ever call me Professor Guseva.
Old habits die hard.
It's Yuliya. It's like Julia, but starts with a Y. So let me start with a general answer first. And I would like to call it an innovation dilemma. So there are two separate trends. Trend number one, innovators and firms need good regulation. Good regulations actually promote innovation. And it all starts with Michael Porter back in the 90s. And many other economists also showed that good regulations, effective and flexible regulations are necessary to promote innovation. But as we promote innovation, there is more innovation. And more innovation poses more challenges to regulators because it undermines the pre-innovation, the pre-existing regulatory paradigms. So regulators are operating under uncertainty. They face an ever-growing information asymmetry gap between themselves and the nimble markets. Consequently, it's really hard for them to regulate innovations and thereby to promote innovators and economic growth. So that's the innovation dilemma. In the United States, as Sharif quite correctly stated, we have another problem, which is regulatory fragmentation. Technically, and since many of you are not lawyers, we have about 100 or so regulators in the financial area. That's a lot, if you think about it. And this is a uniquely American approach to regulating all things finance, or even marginally related to financial markets. Securities, commodities, derivatives, money transmitter regulation, payment systems, et cetera, et cetera. So we basically create one regulator for each new service. Crypto and digital assets, they transcend those regulatory boundaries. So this is problem number one. And my co-authors and I, and I'm co-authoring with an economist as well, started thinking how to determine which regulator in the United States is best suited to regulate crypto under the conditions of regulatory fragmentation and within this innovation dilemma. So this is what we did. We decided to take cues from the market and to look to the market reaction. US regulators, specifically the major ones, such as the SEC, the Securities and Exchange Commission, and the CFTC, the Commodity Futures Trading Commission, they have pre-existing laws, pre-crypto laws, and they enforce them quite actively. So in a way, this is regulation by enforcement, although the commissions, of course, dispute that proposition. So they don't like the term regulation by enforcement, but in fact, this is what they do. So we looked at all enforcement actions in the 4-year period between 2017 and the end of 2021. And we looked at the market reaction, the price reaction of the global crypto market. And we looked only at the largest coins, specifically about, and tokens as well, about 3,000 of them, with the market cap above $1 million. So what are the results? First, the markets react negatively to US-led enforcement. This is not surprising. And by the way, why would markets actually pay attention to the United States? Well, those two agencies and many other agencies within the United States have such expansive extraterritorial jurisdiction that it's really hard for foreign companies to avoid US regulation, specifically regulation by the SEC and the CFTC. So that was finding number one. The finding number two is as follows. The markets really react very negatively, and obviously the reaction is statistically significant to the SEC per se, and much less negatively or even positively to the CFTC. How so? Well, both agencies are US regulators. Both agencies have extensive extraterritorial jurisdiction and rely on pre-crypto laws. So why the difference? To a degree, it may be explained either by the methods, enforcement methods, but they're using, but also by the philosophies and the statutory framework. For one, the SEC is more rules-based. It's very strict. And a little bit less, let's say, innovation supportive than the CFTC. So the CFTC is more principles-based and more pro-crypto in some respects. This may explain the difference as well. So we think that the regulators in the future can take cues from the market, and specifically Congress, which is currently considering as many as actually three bills on who should regulate crypto markets and how to do that.
It's a great point. And I think the difference in some of the work that you've done as opposed to some of the other work I've seen in this space is that you take some empirical evidence and you show it. And I think one of the other takeaways that I have is that you express the short-term changes. But what about over the long term? I mean, can you offer some insight into what happens in the long term? Because it seems like crypto markets bounce back. And so is there really a great effect by enforcement action?
Of course there is. Even the short-term reaction to an enforcement action by a single regulator from a single jurisdiction, which can be completely foreign to the targets and the rest of the market, it shows that both the CFTC and the SEC have the potential to shape the world of crypto. Also, many nodes, let's say for Ethereum, are located in the United States. And with the merge, Chair Gensler, for example, as recently as last week, after a congressional hearing, mentioned something that everyone interpreted as follows. The SEC is going to look into Ether, which may suddenly be found to be a security as opposed to a commodity. Is this going to happen? We don't really know whether this is going to happen, but it shows the long-term effect of those actions on the markets. Most importantly, even a small effect, even within a short time frame or an event window, shows that the markets are really sensitive. Yes, they do. The prices do bounce back, but then they react again, which shows us one important thing. The markets view US enforcement, specifically in the pre-crypto securities law area, as net costly. And this is a good signal to Congress to take action and maybe come up with a better substantive reform.
Yeah. Thinking about that, I wanted to ask Ming's input on this. We talked a little bit about the SEC, the CFTC, but we talked about other regulatory impacts, enforcement impacts. The Tornado Cash example was one you brought up. Can you comment on other regulatory enforcement actions that have had impacts, either both on innovation or in the market space?
Yeah, certainly. And I think the first general point to keep in mind is that a digital asset is not a single thing, right? Anything can be digitized. We live in an increasingly digital world, and it's a question that we should all think about. Just because you digitize something, put it on a blockchain, does that make it a financial instrument? Right? We strongly believe that it's important to look at the nature of the token itself. Right? What are its features? What are its functionalities? What does it enable people to do? So I think it's not a view that you hear a lot, but there are folks at various agencies, even at the CFTC, who have this view, right? Which is just because something can be financialized doesn't mean it is a financial instrument, and therefore should be subject to financial regulation, right? Securities laws clearly financial, commodities laws mostly financial. But to Sharif's question, there's also OFAC sanctions, right? There's money transmission rules, consumer protection laws. And so just talking about OFAC for a while, I think that's really interesting because OFAC, right, which is the Office of Foreign Assets Control, it's a part of the US Treasury Department. They sanctioned Tornado Cash about a month ago. And it's interesting because generally when things get sanctioned, they are entities or individuals, right? And first of all, only non-US persons get sanctioned, right? US persons have to comply, right? So sanctions, the background is a tool of statecraft, right? It's a way to sort of influence foreign policy and promote national security interests of the US. So it makes a lot of sense when you're targeting criminals, right? People doing money laundering, terrorist financing. Makes a lot less sense when it's general purpose technology. Right? So what was really unusual about the OFAC sanction is that they designated not just Tornado Cash the entity, the Tornado Cash website, but also Tornado Cash smart contracts. Right? So they have a list of addresses of Total Cash smart contracts. As far as I can tell, it's unprecedented to sanction software. It's not just any software, it's open source software that's publicly available. Until recently, GitHub had the code inspectable and contributable by anyone. So what does it mean now that we've got software that's prohibited by OFAC? If you talk to a developer or an entrepreneur, and their views resonate with me, because I think there was a talk earlier this morning about DAOs and how DAOs are a great way to get user feedback, right? Understand the community and what they care about. Oftentimes, when you talk to regulators, they care about things like market integrity, which are important. They care about investors and institutions, but not a lot about the actual users, right? And so we go back to the question of what is a token, right? Maybe it's got some financial components. Maybe if it trades, there are market integrity questions. But at the end of the day, there are people who use these technologies, right, for non-financial use cases.
Ming, can I interrupt you for a second? Because I think you raised a great point. What is the mandate of the regulator? Generally, it's market integrity or ensuring fair markets of various sorts. But you don't typically see innovation as part of the mandate of a regulator. So how do companies, how do individuals, how do folks who are out there trying to create and be innovative, how are they impacted by this? Your background, I believe you were at one point a technologist in your career. From your perspective, how do you feel that these sorts of regulatory actions impact your ability to innovate or developers' ability to innovate?
I think it has meaningful impact. I used to be at an incubator and an accelerator, and we would host these legal office hours where we provide general guidance, right? Founders would come talk to us. We'd like to build this and that. Can we do this? And almost in every case, there was a money transmission question, right? And that comes with strict criminal penalties, right? And so people obviously want to avoid that. And so I think some people choose not to launch their product in the US, which obviously is a huge business question. Others try to set up structures where it's partly offshore, onshore for hiring purposes. For the most part, people are struggling with it, right? So maybe we can talk about smart contracts for a second, right? To me, it's a wonderful innovation. You can now launch software with very low cost and low effort, and it's deployed on the network. Anyone can interact with it, right? It's transparent and fairly efficient. But then there's questions about whether a smart contract, right, deployed by you as a developer, is a money transmitter, right? Under US federal regulations, if you accept virtual currency and you transmit it, you are a money transmitter. Right. But then FinCEN also says that if you just publish software, you are cool. But if you have some ownership role, some operational role, not cool, right? So everyone's trying to figure out, what level of control should I build into my smart contract, right? One of the great things about smart contracts is that they can run, they're immutable, no need to change them. But from a practical perspective, how do you upgrade the smart contract, right? If there is a hack, it's a problem you need to fix, how do you do that? If you fix those things, good for users, but it's not now making a money transmitter. So I think developers and businesses struggle with trying to do the right thing in the interest of the users and the community, but without going to jail. And as much as we dislike it, those are real risks that people have to think about.
By the way, cool and not cool, they're legal standards. I promise you.
And if I may add something to that, Ming is absolutely right, except that since many of you are not lawyers, so we have money transmitters, which are regulated at the state level, hence all those dozens and dozens of regulators. So an entity acting as a money transmitter probably needs to get licensed by the state and then another state, et cetera, et cetera. Coinbase is a good example. It's registered in many states. And then we have FinCEN, which is a bureau of the Department of the Treasury. And it also cooperates with OFAC in many cases. So all money transmitters need to report to FinCEN as well. So it's a really complicated web of regulations right there. And as Ming correctly said, the penalties are very strict. And there is that criminal liability in cases of non-compliance. So FinCEN issued at least 2 types of guidance, I think in 2013 and 2019. And indeed, almost any money transmitter, let's say software developer, or even an issuer, which adds a redemption function to the smart contract, may become a money transmitter.
And by the way, when they say strict, they don't mean harsh, although it sometimes can be harsh. It means that there's no mens rea or intent required when you're looking at whether or not these crimes have been committed or these acts have been committed. Wanted to get your comments on another thought that I had while you both were speaking with regards to regulators. We've heard comments saying, well, we use enforcement as a tool to bring some sort of regulatory framework to the industry because we want folks in the space to operate within the spirit of the law. And they want folks to err on the side of thinking, well, how is this going to be enforced, or how do these rules work? Can you offer your comments both from your own perspectives on how that might impact innovators and folks within the market when they're trying to develop technology that works in the digital asset space? And again, I don't think anybody disagrees that digital assets are store of value, right? So in some ways, they can be construed as financial instruments in nature. So can you offer some comments on how you receive that, operating within the spirit? And it's hard to really understand when there is really no framework in this space.
Women want to take that?
Sure. So I guess I would interpret that to mean, don't commit fraud, right? Don't manipulate markets, right? No rug pulls, no scams, right? But even if you sort of, assume that those are being dealt with by the regulators, there's still a question of how do regulators really feel about open, permissionless systems, right? I think everyone has a story about their journey into blockchain. I was talking to folks yesterday, and I think one of the things that really attracted me, and many others as well, is that these are open protocols, right? It creates a level playing field. Anyone can contribute, anyone can participate. Obviously, they create risk, right, of illicit actors. So when a developer thinks about, here's a great way to allow the transfer of money, how do I comply with the spirit of the law? It's tough. It's tough when you don't have clear guidance. And so I think what ends up happening is that people sort of fall back on traditional tools, right? KYC, AML, which don't always work, right, in decentralized systems, or they rely on third-party service providers that do some sort of market surveillance, right? Look at the transaction history. And a good example of that is, again, with Tornado Cash. What sort of transaction monitoring do I need to do, right? Do I just block transactions that came from Tornado Cash? Do I need to look back 2 hops, 100 hops, right? How far back do I go? And so trying to answer the question of how to comply with the spirit of law without clear guidance means everyone's trying to, create their own standards, which is good for innovation, right? When everyone's competing to create standards, but not so great for complying with the law.
Yes.
Do you have a perspective?
Just a comment. I think Ming is absolutely correct. When, let's take the SEC, when they started cracking down on ICOs back in 2017 and 2018 and 19 as well, the main premise was that we are prosecuting fraud, but they also started going after firms that didn't register. So there was no fraud. Firms simply didn't know that they had to register their tokens as securities with the SEC. So that type of violation. And the market reacted in a very strange way. Instead of going through what the SEC would like them to do, specifically register, provide all those public prospectuses, etc., the market reacted differently. They started filing Forms D, which are for private placements and contain almost no information, to provide some kind of perfunctory compliance. I actually ran a study, and there was a huge spike in those Forms D, which were meaningless to many investors. At least this is my perspective on those private placements. And the second point that I wanted to make, also empirical, in that first article that I described, it is clear that crypto markets are not pro-fraud or pro-fraudsters. They react positively to enforcement of the anti-fraud and anti-market manipulation provisions of US securities laws. What they don't like is the enforcement actions involving other types of regulations, but not fraud. Quality and integrity improving enforcement actions are welcomed by the market.
Yeah. I wanted to get back to what Ming had talked about regarding, I think you had previously mentioned AML and related to money transmission. In the instance, so I'll tell an old story from my time as a prosecutor, but whenever we would find illegal or illicit contraband in a location and we couldn't quite tell who was the owner, who was the proprietor, who ran the operation, we picked up everybody and charged everybody, and then watched all of the folks we picked up cannibalize one another until we could find somebody called the flip, and the flip would help solve the case.
Tradecraft.
It's a tradecraft. In our environment of decentralization, and there is a lot of decentralization. I wouldn't say all of our environment is decentralized, because I think there is more of an incorporation of CFI components. But in a decentralized space, and money transmission laws are broken or KYC laws are broken, how do you feel as a practitioner in the space, and you're advising a company, and you're advising students and hopefully future practitioners in the space? How do you feel about this concept that if you can't identify the UBO, or you can't identify the proprietor, or the person responsible, we're going to pick them all up and enforce the law against everybody that we can find in the space? It concerns me a bit as a practitioner in the space, and trying to provide advice for my teams who are in the process of developing and partnering with other developers in the space. Can you offer some thoughts on that?
So, I mean, not great. Don't feel great about it, right?
Another legal standard. Don't feel great about it.
Don't get picked up another standard.
Well, I think one of the issues with the approach is that good actors who want to comply also get picked up, right? So, for example, I analogize self-custodial wallets with web browsers, right? You download a web browser, you can visit any website you want, make any transactions you want. Obviously, if something illegal, you are liable, right, as the user of the product, right, and the provider of the service, but not Chrome, not Safari, right? So I view, decentralized wallets as operating very similarly, right? They're getting more sophisticated. You can use them to browse, do a whole bunch of different things rather than just send and transfer crypto. But what is the responsibility of a publisher of self-custodial wallets, right? Are we expected to regulate the market, to police what people can visit? There's the analogy from a couple of weeks ago that went around about how, securities laws are just like seatbelts on cars, right? If you take that analogy, you're basically telling publishers of software to put some GPS in a car, tell people where they cannot go, what they cannot do, right? Which to me is a bridge too far.
And FinCEN may be moving in this direction.
Yikes.
Right. Yeah, right. Don't have anything more to share with you folks. I know we're coming up on time. I know we're behind. So as a good lawyer does, want to give you back a couple minutes. Thank you guys for having us. We really appreciated this. We appreciated putting this together.